This LOS is explain how deferred tax liabilities and assets are created and the factors that determine how a company's deferred tax liabilities and assets should be treated for the purposes of financial analysis. Differences between accounting profit and taxable income. Current tax assets and liabilities. Differences in accounting profit and taxable income are the result of the application of different rules. Such differences between accounting profit and taxable income can occur in several ways, including 1. Revenues and expenses may be recognized in one period for accounting purposes and a different period for tax purposes. 2. Specific revenues and expenses may be either recognized for accounting purposes and not for tax purposes, or not recognized for accounting purposes but recognized for tax purposes. 3. The carrying amount and tax base of assets and/or liabilities may differ. 4. The deductibility of gains and losses of assets and liabilities may vary for accounting and income tax purposes. 5. Subject to tax rules, tax losses of prior years might be used to reduce taxable income in later years, resulting in differences in accounting and taxable income, tax loss carry forward. And finally, 6, adjustments of reported financial data from prior years might not be recognized equally for accounting and tax purposes or might be recognized in different periods. So we'll do a couple practice questions to help our understanding. Using the straight line method of depreciation for reporting purposes and accelerated depreciation for tax purposes would most likely result in A, a valuation allowance, B, deferred tax asset, or C, a temporary difference. C is correct because the differences between tax and financial accounting will correct over time. The resulting deferred tax liability, for which the expense was charged to the income statement but the tax authority has not yet been paid, will be a temporary difference. A valuation allowance would only arise if there was doubt over the company's ability to earn sufficient income in the future to require paying the tax. Another practice question. When accounting standards require recognition of an expense that is not permitted under tax laws, the result is A, deferred tax liability, B, temporary difference, or C, permanent difference. C is correct. Accounting items that are not deductible for tax purposes will not be reversed and thus result in permanent differences. So when accounting standards require recognition of an expense that's not permitted under tax laws, then there's going to be a permanent difference. Another practice question. When certain expenditures result in tax credits that directly reduce taxes, the company will most likely record A, a deferred tax asset, B, a deferred tax liability, or C, no deferred tax asset or liability. Okay, this is a good question. C is correct. Tax credits that directly reduce taxes are a permanent difference, and permanent differences do not give rise to deferred tax. Deferred tax assets and liabilities. Deferred tax assets represent taxes that have been paid, or often the carrying forward of losses from previous periods, but have not yet been recognized on the income statement. Deferred tax liabilities occur when financial accounting income tax expense is greater than regulatory income tax expense. So think of that example. I always like to use one example, and if you can stick with it, then you'll kind of understand. On my financial statements, I'm using straight line depreciation. For my income tax, under the income tax law, I'm allowed to use an accelerated depreciation like double declining balance. So what's going to happen there? From an income tax perspective, I'm going to have higher expense because I have higher depreciation expense. I'm using accelerated, so I'm going to have less tax payable, okay? So that's why I've got a tax liability on my financial statements, because I've recognized less expense using the straight line method, okay? Deferred tax assets and liabilities usually arise when accounting standards and tax authorities recognize the timing of taxes due at different times. For example, this is my example that I use. When a company uses accelerated depreciation when reporting to the tax authority to increase the expense and lower the tax payment in the early years, but uses the straight line method on the financial statements. The temporary difference is the difference between the net book value of the asset for accounting purposes and the net book value for taxes. So you have to be able to do double declining balance calculations if there's an actual calculation problem, okay? So continue with deferred tax assets and liabilities. Under IFRS, deferred tax assets and liabilities are always classified as non-current. I put that in bold. Under US GAAP, however, deferred tax assets and liabilities are classified on the balance sheet as current and non-current based on the classification of the underlying asset or liability. And that's the last slide for this LOS. Thank you.